Welcome back to my channel. In this video I'm going to give you the Q2 GDP forecast of where I think it's going to be and what it's going to hover around, as well as give you a Q3 economic outlook and cover the various market indices. So I'll cover the stock market, the bond market, precious metals, and just tell you where I think things are going to be trending in the next 3 months. Now this is more of a speculation and an idea. This is not really going to be based off of hard data or anything. It's just really based off of my own observations of where I think things are trending, as well as my own instincts and beliefs and philosophies of where it's going to go based off of my own understanding of the economic paradigm that we're in. So one of the things that I find interesting is that the Atlanta Federal Reserve produces a GDP forecast that they call the GDP Now. This is where they take various economic data reports that come out throughout the months, and they kind of give you a gauge of where GDP stands, and then forecast that out and say, okay, if this was going to continue for the quarter, where's that going to go? And that's represented by this green line. Now this blue line here of GDP growth for a quarter is represented by a consensus of top economists, and I think it's like the top 10 or 20 economists, but it gives you that kind of range, a high and a bottom. It seems to be the range of top 10 and bottom 10 average forecast, coming out of Wall Street and various pundits that are going on. So that's been aggregated here to show you where the GDP Now has been in relation to it. Now, one of the things that you need to pay attention to is look where the GDP Now started back in early May, and look at where it's ended up. Okay, so it's been on this just staunch downward trend, and this is something that the survey of forecasters are not taken into account. And as a matter of fact, it's not even in their bottom range. The GDP Now forecast is showing that GDP is looking to be ending up around 6.4% for the second quarter of GDP, whereas the survey forecasts are showing GDP to end up around 8 to 9%. Okay, the bottom range has it saying it's not going to go below 7. Yet we're seeing the GDP Now model telling you that it's going to hover around 6.4. Now maybe the model's going to be a little bit off. Maybe GDP comes out a little bit higher, but it's still, if it comes out below this 9%, especially below the 8% threshold, I can't see it as doing anything else but be bearish for markets as investors get worried that various world indicators and economic indicators are pointing to a stock market peak and a sell-off in the stock market. The COVID Delta variants that's been going on, the sluggish economic recoveries, the recovery is stalling out, and then there's obviously the threat of rising price inflation. So this is very interesting to take note of that trend. Meanwhile, this should prove to be bullish for gold and silver. So here's a silver chart that's been going on, and I wanted to take note that the long-term silver trend is pushing upward. I know that many people have been frustrated that silver's kind of been, flatlined since it peaked in August, but if you noticed, its ceiling has pretty much stayed steady around this $29 an ounce area, but its floors keep rising. This is very bullish for silver. As this wedge continues to tighten, silver should gradually start pushing up in the next 3 months. Now, I'm not saying that it's going to break out in the third quarter. Don't get me wrong. Don't expect, amazing returns in the silver market, but I could easily see silver continue on this trend, and where it started out to go up to say about $27 an ounce, as it just continues to push outward and upward and constrain that wedge and force that ceiling. And then eventually, sooner or later, depending on how volatile the markets get in the third quarter, which they very well could if I'm right about my price inflation forecast, they could test that ceiling and push that ceiling upward, but the floor should end up around $27 an ounce. Gold is following a similar trend, but it's a little bit more interesting of what's going on. So gold is on a downward ceiling pressure, but it's on an upward floor pressure, but the upward angle is stronger here than the downward pressures on gold. Okay, so I expect that these two will converge in the middle sometime in the third quarter, and if the trend continues, which I expect it will because of rising inflation, as well as now we've got another monkey wrench to throw into the situation, a third wave of the coronavirus coming in, this time in the form of the Delta variant, as well as the Lambda variant, spreading infections and increasing the risk that governments might take restrictive measures on their economies again, or at least restrict trade, especially on the global fronts. That's going to be conducive for a strong gold price, and I expect that rising floor to overwhelm this falling ceiling, reverse the course, and start pushing gold upward north of $1,850 an ounce. Probably, in my opinion, we should see gold break through $1,900 an ounce before the end of the third quarter. Okay. Which leads to an interesting situation that's been going on is the stock market. What's going to happen with the stock market? Well, as I said before, I believe the stock market is going to be near its peak. And I said that the inflation numbers in August might be the death knell to it, because when the July inflation numbers come out and they show that the inflation is going to push up over 6%, because right now, what is this? The inflation numbers are at 5.3% as shown by the Consumer Price Index. They won't push quite up to 6%, but I forecasted that they would push up to about 5.7 based off the Producer Price Index of final demand. That could be the death knell to stocks and say, wait a second here, these inflation numbers are more permanent. What I find most interesting about this is that Jerome Powell has come out and just admitted in the latest Fed meeting that inflation numbers are going to be more persistent than they originally thought, and higher. So he has finally come out and admitted that the inflation numbers are going to last longer. They're going to be higher than he anticipated. He's still chalking it all up to supply bottlenecks, whatever, but he's at least acknowledging that. In the meantime, you can see that the stock gains have kind of flatlined on their peaks and such. And then here's this huge dip in July as there were worries about inflation taking over, but it seems to have rebounded. I believe that these weak GDP numbers are going to push stocks downward, because it's not going to be the GDP numbers themselves that are going to be bullish for stocks. It was the expectation of those GDP numbers, and the expectation is that those GDP numbers were supposed to yield 8-9%, and if it comes below expectations, that's going to seem bearish, okay, combined with what's been going on. Now, with rising inflation and uncertainty, you would think that interest rates would start forcing themselves upward, but I don't see that as the case of what's going on. Instead, what I see is a case is that temporarily in the short run, and I'm using the 10-year Treasury rate here, I expect that these rates will stay and hover around the 1.2 to 1.3% area. Now, they should get forced upward from this rising floor trend eventually, but it's going to be a gradual rise, and these rates function as the rates of all other interest rates. So here, I've got the 10-year Treasury, and I've got the junk bond interest rates from Bank of America, the Bank of America measured index for these, as well as the Bank of America measured index for AAA corporate bonds. And you can see here that they correspond very tightly to this 10-year rate, okay, especially for in the last 6 months, as investors have been chasing yield, have been driving down the interest rates of these junk bonds, and with the Federal Reserve engaging in massive QE for the past year, it has been keeping these interest rates lower, and despite recent inflationary trends, these bond interest rates have remained stubborn and will continue to do so. One of the reasons why I think so is because investors usually flock to bonds because they're more liquid investments, and they are trying to put the money into the bonds temporarily and out of the stock market because they expect that these headwinds will reverse sooner or later, okay? So if you buy precious metals, if you say, okay, well, I'm going to buy gold and silver, you're not going to reverse that buy. You're not going to just go sell the metals back on the market the very next day. You're usually going to wait. You're going to hold these precious metals for the long run. But investors, they are still thinking that this is going to be a short trend, even if it's going to be lasting for 3 to 6 months. So we could see these interest rates stay lower for longer, even with falling stock market, and it's probably going to put us into a situation very similar to 2008. So one of the things, I'm going to go ahead and pull up this chart and then I'll wrap up. One of the things that I find interesting in 2008 is that unlike the 1970s, the interest rates were falling in 2008, driven by Fed expansionary monetary policies, yet the gold price continued to push upward. Okay, so you had a situation where gold pushed upward and bonds pushed downward. Okay, I think we're going to be seeing a similar situation develop between gold and bonds. Okay, so here we go. We can see that back in the 1970s, right? You can see as interest rates pushed upwards, so did gold. Gold and bonds seemed to be going in tandem with each other. There was a bond sell-off. The money was flowing out of bonds. The money was flowing out of stocks. They were going into gold. Yet in 2008, when the credit bubble burst, okay, well, money was flowing out of stocks, bullish for gold, but they were also flowing into bonds. So there seemed to be a divide among the investors here, okay? Some of the investors believed that the stock market fall was going to be temporary, so they put their money into bonds to be held, to take it out and push back into stocks, not to mention that the Fed was actively buying bonds and engaging in massive quantitative easing programs. Others believed that this was going to be more permanent. They expected that inflation was going to rise from the Fed's expansionary monetary policies. They were going to be disastrous for the economy, and so they started buying gold. I think we're going to see a similar divide transpire here in the third quarter, where we're going to see gold push upward just like it did earlier, and bond rates push downward. So if you noticed early on in the coronavirus pandemic, we had gold push upward, we had bonds push downward. Then we see a sell-off on gold and a sell-off on bonds, which coincided with the recovery of the stock market on Wall Street. And I think what we're going to see is more a reversal of this trend. We're going to see gold push up. We're going to see bond rates push down, so bond prices push up temporarily, which leads to a lower stock market because funds are flowing out of the stock market. Then sometime in the future, these long-term persistent trends are going to push those interest rates up, and the money will come flowing out of the bonds and flock into the precious metals, and that's what's really going to juice up the bull market for precious metals, as investors painfully realize that the inflationary numbers are much more persistent than even what the Fed's admitting now, that they're here for years because of expansionary monetary policies, and that will signal pretty much the end to traditional investing for the next, say, decade or so, or until the Fed decides to reverse its monetary policy course. And that will lead to a bull market in precious metals, at least for the next few years, I think. So that's my thoughts on what's going to happen in the next few months. It's going to be really exciting. Unfortunately, it's also going to be very alarming. I encourage each and every one of you to do your own due diligent research, to stay vigilant in these markets, okay? There's money to be made. Where there's disaster or where there's crisis, there's opportunity. So just do your diligent research. For me, as I've said before, I've put my money and I've gone long on precious metals because I think that that's going to be the overwhelming safe haven bull market in the long run, at least for the next few years. But we'll see how things play out. Make sure you guys to hit like and subscribe. If you like my content, just hit that notification bell, subscribe to my channel, show me support, like my videos, and you can always watch other of my content on my channel. Thank you guys for watching this, and I'll probably push another update, especially in regards to the aftermath of the GDP numbers, sometime either tomorrow or this weekend.